couple weeks having a lot go on in the markets. Wanted to update the technical backdrop and what we're watching for now. So a couple of weeks ago we outlined these two trend lines we had, which we deem as the two major trend lines we have going on. The one from the March 2009 lows that ran into the summer 2010 lows as well. You can see here we lost that one in late July coming into August, and the other one was simply the summer 2010 lows here that we had in June and July and August. And you can see last week we lost that one as well. Now there's one more that you could make the argument we have not yet lost, and that would be from the June 2009 lows coming off the bottom in March through the summer 2010 lows. This is really the last line of defense, so to say, and although it was violated last week, the S&P did manage to close above it, so technically it hasn't broken that trend line until it gets a close below that. But really we think the main trend, which was the summer 2010 and March 2009, those trends are now broken. And so there's some levels to watch which have already come into play. Now you can see in going into 2010, we had a nice strong rally off the bottom here, pretty much for about 9 months, from March all the way through January, before we got any real consolidation in the indexes. And that occurred at around the 1050 level to, it was really a wide range, to about the 1225 level. And so this is kind of the range we have now ventured back into, and you can see we found support right in the middle of that range, really in this channel here, which was once again those summer 2010 lows on the S&P. It was a range between 1010 and 1100, just about. And you can see the index found support nice and even at 1101, just above that key 1100 level, nice psychological level, and it's really made a nice hard bounce from 1100 all the way back up to 1205 currently. So we're talking about a 9% bounce off the bottom, which is a lot. And the thing to be on the lookout for is, where might this bounce that we're getting, where might it start to come under selling pressure again? Well, the first level it started to get back into, that would be last week's close, 2 weeks ago's close, which was 1199, so 1200. So we started to get back above that 1200 level, and really we'll then focus on the March lows from this past year, which acted as support. That's 1250, acted as support in March and again in June of this summer. So really now 1200 to 1250 is a key resistance zone where we would expect there's some supply that's going to come out in this range, and that's where we think this rally could start to fade out, somewhere in this 50-point range. And on a more intermediate basis, let's look at what happened last week. The nice thing about last week's violent downturn is we got a nice channel now that we can focus in on and watch from here on out moving forward. And that channel consists of the lows and the highs from those 4 whipsaw days last week. So we're going to put that right between 1120 on the S&P and 1175, we'll call it, on the high side. So 1120 to 1175 is going to become a key zone on any pullback. This is where the market has bounced from last week, so a re-entry into this zone, there should be some demand down here to help put a floor under prices. But in the event the markets maybe rally up to 1225, 1250 or so, and then start coming back down into this range, if they were to fall out of this range, really 1120, even though it did bounce off of 1100, the real daily ranges were between 1120 and 1175. So that 55-point range is going to become very important, because if it breaks below that range, we're likely then going to have a retest of 1100 even. And a breakdown beneath 1100 would then set the stage for that retest that we talked about of this very wide range from the summer 2010, which was 1010 to 1100, and really 1050 or so was a point of congestion. If you see here, there was a lot of support on 1010 in February 2010, May 2010, June 2010, August 2010. So 1050, key level to watch. If we break 1100 to the downside, our bet would be on a definite move down towards 1050. And one other thing we'd like to point out is from the April and May highs, 1370 on the S&P 500, to the 1101 low last week, the S&P declined 19% from its highs. A decline of 20% or more from recent highs is considered the start of a new bear market. Now, we didn't get that on the S&P 500, but we did get that on an index that we do follow relatively closely, and that's the Russell 2000, which is a major index for small cap stocks. The Russell 2000, from its May high of 868 to its low last week of 640, did officially enter a bear market. It declined about 23-25%. So this is the index that's really, really vulnerable on rallies to come under selling pressure. So we recommend watching that as somewhat of a leading indicator as to what the S&P might do next. So really quickly, if you look here, the Russell throughout all of 2011, before this breakdown a couple weeks ago, found support on numerous occasions at the 770 level. In January 2011, March 2011, and most recently June 2011. 770 was a key level. So just as this level acted as good support, now that we've breached below it, we're going to be watching to see how the Russell trades as it gets back up to this previous level of support. Much like the S&P with 1250, we feel that the Russell is not going to be able to get over 770. There's going to be too much supply on the way back up, as previous support will turn into resistance. Now, also with the Russell, similar to the S&P, we've lost all the major trend lines that it had going for it off of its March 2009 bottoms. And so that was the loss of that major trend line, and it did hold the trend line from the summer 2009 and summer 2010 lows. Just like the S&P, that trend line was violated, but technically it did not close below it, so it has not been broken. So it's another level to watch. We're looking at a weekly chart, mind you. So on a weekly basis, this trend is going to be right around 690 to 700 over the next couple weeks. So a weekly close on the Russell below 700, we'll say, is going to be a bad omen, we would think, for the overall markets. So just some things to keep in mind. Traders need to remember that the markets did get extremely oversold last week, so a bounce of this nature shouldn't be too surprising, because nothing goes straight up and nothing goes straight down, so you do have to bounce at some point. It was just a matter of time, and that's what we're getting right now. But that doesn't mean we've put in our bottom. This volatility that we've seen the last couple weeks is not the type of volatility that is associated with bull markets, but rather the type of volatility that is associated with new bear markets starting. We'd like to remind people that the last time we saw this much volatility was April, May 2010 and September 2008. Now, if we go back and look at when that huge volatility started, if you look, September, obviously, in 2008, we know what happened here. That the start of it was that first week in September, and the markets really fell off a cliff. And then in April 2010, going into May with the flash crash, we had that same volatility, and the S&P went from 1,200 all the way down to 1010. So we've seen that same volatility, similar to what we saw in May 2010, except this time, instead of seeing it from 1,200, we're seeing it from a starting point of 1,300. And we've already made that leg down to the 1,100, 1,200 range. So bottoms aren't that simple. It's going to take more time. You can get a nice bounce here up to 1,250. You can come back down to 1,200. We can bounce around a little bit. But you need to understand that things like this, bottoms take time. If you look after that volatility in May 2010, we went through a bottoming process that lasted about 3 months here from let's see, from May through August. So yeah, 3-4 months we traded in that range. Same thing here in 2008. We traded in a range as well for a really long time. Now, obviously, we broke down below that range, and it was very, very hard to have timed that bottom immediately since it was such a V-shaped bottom. But astute traders still would have gotten a great entry point had they recognized the channel that had developed here between 840 and 960 on the S&P. You had a lot of congestion there from October 2008 through July, August 2009. So we're talking about a 10-month bottoming process in 2008 and a 3-4 month bottoming process in 2010. So here we are now, 2-3 weeks into all of this chaos, and you're reading headlines wondering, is the bottom in, and all this and that, and it just doesn't work like that. It takes a lot more time than 2 to 3 weeks. Got to give it at least 30 to 60, more likely 90 days, possibly even longer. So respect the channel, and that channel, once again, on the downside is going to be 1120 to 1170, 1175-ish. You want to watch pullbacks in that channel, how the markets respond. And that channel on the upside is going to be 1250, 1260 on down to 1225-ish. You want to see how the markets respond up there. In between 1175 to 1225, you're really in no man's land. There's no real price establishment in that range. So really today, you know, we wouldn't recommend doing much of anything. Just sit back, have patience, let the market figure itself out, find out what it wants to do on its own, and wait until the technical backdrop becomes more clear. Now, if we get a move up to 1225, 1250, and you see that the market starts to drift or stall out on high volume, that would be a sign that supply is coming into play, and that would be a good time to possibly put on some shorts. Vice versa, if the market pulls back to 1220, 1240, 1120, 1140, 1150-ish, and it starts to bounce on high volume, that could be a sign that it's a good time to get long and catch a move back out of this range, back on up towards 1225. So you've got your two ranges to watch. Respect them, have patience, and let the market figure itself out.